Hi, Simon. It's wonderful to have you on Me and the Market Goliath podcast again for the second time in almost 2 years. How have you been?
Fantastic, Kelvin. It's nice to be back here with you again, and thank you for inviting me onto your show. A lot going on in the market, so no shortage of things to talk about.
Last time I invited you to talk about innovative technology and your view on investing in disruptive tech companies. Our conversation in episode 23 of my podcast, which I highly encourage everyone to listen, was so fruitful and you have shared so much wisdom that it left me with one regret, which was I wish I had more time to deep dive into your investment philosophy and how do you manage a stock market research subscription business, 7investing. So thank you, Simon, for giving me a second chance to have more time with you to talk about your personal investment philosophy, 7investing, and what's like to be the founder and CEO of the company. What are some of the challenges of running a stock market research company with your lead advisors? Before we learn some of the takeaways from your recent attendance at the ClimateTech Conference at MIT University. So let's jump right in with my first question, which is how would you describe your investment philosophy?
Well, you gave me the perfect setup for this one, Kelvin, because you told me that our first time we chatted was episode number 23, which for any basketball fans out there was Michael Jordan's number. So I'll frame that to say that, my philosophy is to play offense and play defense. I've got two portfolios. One's going after the opportunities, kind of the growth style opportunities that I think are at least worth 3 to 5 times what they're worth today over a 3 to 5 year period. So that's the offense team. And then defense is the opposite, where to help me sleep at night and just not go all in all the time, I also have kind of a long-term dividend paying stable companies that I reinvest and compound over long periods of time. So some people call this the barbell approach, but maybe the offense and defense is a little bit more descriptive.
How has your investment philosophy changed over time?
Yeah, a lot of people kind of think of growth style investing as you have to be first, right? You've got to be running ahead of the rest of the pack and find the sexiest new trend and find the companies that are at the very, very forefront of that. And I used to think that too. Whenever there was a new trend that I'd get a hold of, I'd look for the first publicly traded company because I thought the top dog and the first mover was always going to be the ultimate winner. And that is not the case. More often, it's not the case that it's normally the second or third or fourth company that learns from the mistakes of the first one who runs off the cliff. Yahoo showed us this when Google became the leader in search, and then Yahoo showed us this again when the Trade Desk became the leading demand-side platform, both of which Yahoo was first to. And I think that maybe perhaps as an investor, I don't run so quickly into new trends, into the first options that are available. I like to try to figure out what is it that's interesting about this market that's new. What are companies doing that the existing players cannot do right now? And then who is actually showing that they can not only get revenue growth, which is very important, but also scale a business that's profitable for investors. And so just a concrete example of that right now, there's a fascination with quantum computing. There's a rush out there to buy IonQ and these first couple publicly traded companies. I think it's far too early to start calling the winners in that space. But it is something interesting that's worth keeping an eye on.
As a business owner, do you approach life the same way as you invest in companies?
Yeah, well, as an investor, everything, you always see it as an investment, right? You go to Chipotle and you think, oh, I own Chipotle stock. I'm helping out the top line here. As a business owner, it's the same way because when you're running a business, you kind of get some insight and some context into what's really going on with these companies. You're not just reading an investing relations presentation, you're using what they've got, right? We've got a marketing team at 7investing. So we size up the different marketing channels and platforms to use for placing campaigns. We have an operations and IT team. So we see the tools that our developers are really excited about using for the website that they have to use because they're so embedded with them. I mean, I think things like that, at least it's given me a really good appreciation of, when companies say we're a must-have solution, you can kind of make your own assessment of, do you need to have that or do you not really need to have that? Kind of helps to inform the companies you want to invest in as well.
So many would say that 2020 to 22 was a tough year for businesses with COVID and layoffs and with rising interest rates. What were some of the challenges running 7investing as the CEO?
Yeah, well, gosh, COVID just changed everything. I don't think I need to tell anybody how big of an impact that had on the world. For investors, there's one part of it that's the business side of it that was just kind of blown up and nobody was going to work and, we're figuring out work from home and all of that. On the other hand, if you were investing through that period, you were getting a pretty good bargain on a lot of those companies because their market caps fell significantly during the time. The challenge, of course, for us as a business really came in 2022, a couple of years later, when interest rates just shot up so much more quickly to constrict the economy as a kind of an aftermath of the stimulus that went in during COVID. And so, of course, Fed is pumping up Fed funds rate and interest rates are following right along, and it's really contracted the stock market. Now, the average individual investor lost 30% in 2022, and 1 in 5 closed down their brokerage accounts. And so those are huge headwinds when you're an independent company like we are, who's making stock market recommendations. But on the other hand, we also think that, this is kind of natural in the cycle of investing. This is natural in the business cycle, that the economy expands and then it contracts. And we've never said we're a business that wanted to go out and, bet the farm on one single year. We're going to be in this for the long term. And we have for 3.5 years, and we're going to be around for 3.5 more years. And, we're going to see more ups and downs during those periods too. But I'm kind of always excited to be an investor. You can adjust your style based on the macro, but I think more important is the response of the companies you're investing in, how they respond to the macro, and if they're built to last or not.
I want to flip from the consumer's perspective who's subscribed to your business, which is quite interesting, which is what are the top reasons for trusting a stock market research company to provide retail investors with buy and sell recommendations? We invited founder and CEO of 7investing, Simon Erickson, in this podcast episode and episode 23 to share with us what 7investing is all about, as well as his knowledge on investing in innovative companies. So we partnered up with 7investing, which you can support my podcast, Me and the Market Goliath, today by signing up to 7investing's annual newsletter subscription. By signing up, you will receive their 7 highly recommended stock picks per month, research reports, video deep dives from their lead advisors, and monthly subscriber calls, including all of their previous stock picks and exclusive access to their members-only community forums. You can use promo code Goliath to enjoy $100 off on their annual membership subscription for just $199. So maximize your market intelligence with 7investing's newsletter service and lead advisor insights today.
I think that trust is everything in our industry. We're going out, we're making investment recommendations that people will put hard-earned money into and trust us that we're, 1, doing our research, and 2, being honest with them. There are a lot of investing newsletters out there. There's very low barriers to entry to anyone to set up a Seeking Alpha page or a Substack page or whatever it is. You can just publish and get a following. I think that in many cases, there's a lack of integrity from people that are abusing that right and the responsibility that comes with it. I've seen certainly on Twitter and other platforms, people pumping the own stocks that they own just to try to get more people to buy them, just to push the price up so they can get a pop and then get out whenever they want to. That's certainly not responsible. I've seen other investing services that have taken the sells off of their portfolio returns because they wanted to brush those under the rug and forget about them. That's certainly not responsible either. I mean, for us, if you're going to be trusted, you've got to earn that. And that's why I think that 7investing has spent so much time being fully transparent on our own scorecard about every single one of our recommendations, even those that we sell. We don't go out there and trumpet our recommendations to social media or the public world. We keep it behind the paywall. And we say, if you want to see the picks and actually see our conviction in them, that's something that we charge for because we don't want to be confused with others that are out there pumping their own stocks. But to answer your original question of, what is our role as an investing newsletter for retail investors, it's to empower. And to truly do that, the reason we have really good retention and really good NPS scores is because the people that have stuck with us see we're a little different than a lot of the others that are out there. And we're very proud of that. And we're going to be long-term investors. And we're going to be very transparent about everything that we're doing.
I'm sure you get this question from time to time. How does 7investing's stock market research tool and platform compare to the likes of Seeking Alpha and Motley? I know you previously worked for Motley. So I'm sure you know what's the discrepancy between the platforms.
Ours is kind of a neat approach because we have a wide variety of picks. There are several services will kind of be thematic or built on a certain trend, right? This is an AI portfolio. This is a biotech portfolio. We just say the whole market is your ocean to choose from, to go fishing in, right? To me, with our advisors, it doesn't matter if you're picking a dividend stock or a high growth micro cap biotech stock. It's all fair game, and you pitch it to the rest of the team. And we kind of fight it out. We kind of throw the gloves off and we challenge each other. And we put the risks right there front and foremost in our reports. Our job is to say, this is what I think is the best pick in the market right now, times 7 more of those, because we're presenting 7 picks every single month. And then for anyone who's a subscriber, most don't buy all 7. Most find the ones that would fit right for whatever their type of investing is. If you're retired and you want income, you might look for income picks. If you're putting away money every month into growth style investments, you might want those higher flyer, riskier stocks. But investing is such a personal thing. And as opposed to kind of maybe looking at a smaller window of the market, for us, the entire market, including the international market, is fair game every month.
As you know, I had the luxury to invite other 7investing lead advisors to the podcast, such as Luke and Dana. Really privileged to have them to talk about the health tech and care space. How do you recruit your lead advisors? I'm sure that's a huge component to the success of your business. So how do you approach recruiting great talent to your team?
I always went after the people that I trusted. And I said, if they're making recommendations, I would trust to buy those stocks myself. You mentioned Dana. Dana was running the South by Southwest healthcare conferences that I would attend for years up in Austin. And when I saw the sessions, I said, man, whoever's putting these together is doing a really good job because these are amazing. I found out it was Dana. I would always go out to the taco truck with her and have coffee with her every time I'd go to South by Southwest. And then naturally, just from the friendship we had, she joined as a lead advisor at 7investing. Luke was doing a fantastic podcast that I had listened to for a long time, all about innovation. I said, man, this guy is really smart. He's really thinking ahead of the curve. He would be a great fit as an advisor for 7investing. He came out of his retirement to be a lead advisor with 7investing. For me, it's kind of like that long-term focus, the focus on innovation. We have 3 PhDs and an MBA on the team. I mean, we're thinking about things a little differently than a lot of Wall Street and institutional investors are, which is kind of neat too, because when you're looking at stuff that is these long-term trends that are developing, you've got to kind of separate out who's out there trying to raise money but doesn't really have a fantastic business model versus, who is really in the right place at the right time and is going to capitalize on that.
Whoever you're going to hire in the future might have to listen to this podcast, because the question I'm going to ask is about the recruitment process. What is it like? How rigorous is it? Because whoever you're going to hire are going to provide recommendations, and there are repercussions for people who are reading your newsletter if they're investing based on your buy and sell recommendations.
We don't have a checklist or anything that you have to check all the boxes. It's kind of been a wide variety of that, I suppose. The people that have joined the team I've known for a long time. It wasn't anything that was just kind of a first meeting, first introduction, and then you're hired. It's something that you kind of build up from interacting over a while. I personally think that the number one important skill for an advisor is the ability to be open-minded and learn. There's a lot of ego in this business, and a lot of people think they're always the best investor. I think that more important is to kind of recognize where you're not the best investor. And do you have the curiosity and the interest in expanding your own capabilities? So you're able to learn things that you didn't know before. Or are you stuck thinking you know everything about one sliver of the market and you're always going to recommend the same 3 companies that you know really well? For me, I'm more interested in somebody that says, I've never recommended a biotech company before, but I've been learning about this for the last year and I've been talking to some really smart people about this. It's ready to actually dip a toe in the water and so forth. And I think that's one of the compliments of our team being so diverse, is that we're not going in this kind of, we're seeing a whole lot of different viewpoints from a lot of really smart people who've done this for a long time.
I've always pondered the question with regards to emotional intelligence and intellectual intelligence. I'm sure it's a huge attribute when you hire investment advisors. And there's a lot of investment biases when you get involved with investing. So how do you test for investment biases? How should advisors test for investment biases in general?
There's so much noise out there right now. This very moment, there's probably 1 million new headlines globally that are being published. The percentage of those being automatically published by GPT or some kind of generative AI is increasing as well. And it's all kind of based on biases. What's the perspective of the person writing that or the machine that's writing that? And we read a lot of those and we'll quickly be influenced by the first thing we read. You can't read everything, unless you are the AI. You can't go out and read every article and figure out which one you want to believe. But the bias is perhaps, who do we follow on social media? What publications do we follow? What is our source of information? And then how does that influence what we think is the truth as an investor? And so as an advisor, the way to counteract that is to maybe not place as much stock in investing presentations, which certainly have a bias because they want to make their company look as fantastic as possible. Even financial media, when you hear something as a fantastic quarter and it beat expectations and earnings per share, yeah, that could be true. Or the other way around, that they missed when everyone's selling out the stock. It's kind of, I think, more advantageous to look at what's going on a little bit behind the curtain or the second or third layer of the onion. The only way you can do that is you have to have some kind of dashboard that gives you financial information that's a step removed from the headlines. If you're making your decisions based off of adjectives and headlines and titles of articles, you're already playing to a bias. If you're going in with a complete objective stance and you're saying, okay, I see why they spent more money than they were expecting to on R&D or on capital expenditures than what they were telling the street, and this is why they missed earnings per share. Maybe you might still, as a long-term investor, say this is a great opportunity for them to be doing this, or the vice versa. Maybe they're just, trying to grab profits too quickly without thinking things out. I mean, that's the second or third layer that a good advisor should be able to expose. There's been plenty of times this year alone, I can tell you that even stocks that we've recommended, we see the enthusiasm for them out there in the market, and we came back and we would say, wait a minute, I'm not so sure about this. And we found some things that weren't as optimistic, or vice versa, where it seems like stocks would sell off for the wrong reasons. And those could be opportunities for stock investors to buy. So we all have biases. Every one of us has a bias. It's whether or not you're able to acknowledge them and try to get past those, because stock picking, the market's always right. Over the long term, the market is right. Whether you can say the market's wrong if you want to, but that's just fighting uphill. You've got to figure out what's going on out there. And typically cash flows is the biggest, cash flows and revenues are the biggest indicators of what wins over long periods of time.
I do think that studying companies is actually quite difficult. It requires a lot of time, and it's hard to quantify time. And when you hire lead advisors, I'm sure there's some sort of prerequisite when it comes to studying a company. Is there a time factor in terms of how many hours should lead advisor study a company before recommending to buy or to invest?
Yeah, maybe I'll spin that a little bit to just say investors instead of even advisors. How long should you follow a company? And I think that the answer is as long as you need to be comfortable with it. I would advise against going out and reading 20 seconds about a company you've never heard of before and deciding that's where you're going to put your money into it. Right? You're buying into a business. You want to at least know who's running that business. What is their job that they're getting paid to do for running that business? Why not invest in another competitor that's trying to do the same thing as that business? Is there any advantage to this business as opposed to everyone else that's doing the same thing? I mean, once I think you get a kind of a basic understanding of those things, it's okay to take an early stake without backing the truck up. And I tend to like to invest more and more into companies I get more and more comfortable with. I can't remember the last time that the only investment I ever made in a company was the very first initial stake.
Do you think an investment research tool or a newsletter tool could have prevented a black swan event for the majority of investors, for example, dating back to the dot-com bubble or 2007 and 8 financial crisis?
Well, there was a neat book, it was The Big Short, which was all about Michael Burry, who exposed the housing subprime lending crisis. Like, think about Michael Burry as like AI, right? AI is not going to be able to do that. They're going to go to a deeper level of research of the information that's available out there. And so tools should be able to find these black swan events and at least the indicators that could proactively prevent them. Now, the question, is it going to matter? There were people that were slamming their fists on the table, even in 2007, saying, hey, we got a problem here. Michael Burry was one of them that was shorting the market. The whole book is about, Michael Lewis wrote about shorting the market that Michael Burry was doing. And all of his investors hated him for doing this. And it turned out he was completely right. And so when the S&P drops 40%, he made a ton of money off of it. Most people still will not do that. I'll tell you that during the next bull market at the top, when there's euphoria and optimism in the market, but even if these possible problems are exposed, most people are still not going to say, you know what, I'm out and I'm shorting the market because I think it's going to be a massive sell-off out there. Because the market is a giant market auction. It appeals to our emotions. And, are we super excited and euphoric about investing because everyone around us is making money? Or do we feel like crap every day because we've lost money and we can't imagine how our portfolio is down 20 or 30 or 40% for the year? Somewhere in between those two extremes is investing. What do you personally want to do and what do you personally want to commit your time to? Most people aren't going to spend 80 hours a week doing what Michael Burry did, which is rows after row of interest rates and subprime mortgages. But I do think that perhaps your style as an investor, if you are a longer term investor, you don't get as worked up over the ups and downs. Hopefully you can have kind of a little bit of a margin of safety of what you're buying or a little bit of cash on the side. So when there are downturns, you're excited to buy stocks and add to your positions you like, rather than just, being really frustrated that the market's going down. I tend to think of sell-offs as buying opportunities.
And I did want to get your insight in terms of stock picking. And for 7investing, it's about long-term looking into attractive investments. And being a long-term investor is difficult because there are some statistics out there that show the average stock holding period is actually very short. And it really makes us question retail investors claiming that they're a long-term investor. They say they are. So according to analysis of data conducted by Reuters on the New York Stock Exchange, by the way, I also post these references in my show notes, results showed the average investor holds shares for 5.5 months. So what does this mean for those who are holding these stocks longer than 5.5 months?
I typically think about 3 to 5 years. I consider that a pretty long-term investment. If it's longer than 5, it's something I'm committing for the long run. Things do change out there. Sometimes even great companies, it's okay to sell if things turn against them. But I do think that you have to give at least a couple of years. 5.5 months, that's less than 2 earnings releases, right? Like how do you build a strategic plan if you're a CEO, if you're only thinking in terms of 6 months? You're investing in companies with CEOs and leaders that have been around for years, for decades, right? Jensen Huang at NVIDIA, that didn't just happen out of nowhere. He built that business over years. Lisa Su at AMD, that turnaround story for that took years. You can't do that in 5.5 months. You got to go out and build the right programs, figure out what you want to do, hire the right people, and then start building upon the success and the momentum that you're building within a company. And if you're smart, you have a 3-year plan. Any company that's worth its salt has got at least a strategic plan that's not thinking in terms of 5.5 months, but is thinking in terms of 3 years. If companies are good and they hire the right people and they have the right CEO at the helm, they're going to give regular updates on what it is that they're hoping to accomplish, and you should see it trending that way over time. 6 months is way too short to assess if a company is executing. Otherwise, you're just kind of in and out against the algorithms for short-term noise.
And how do you think investors can avoid that from selling stocks for 5 months? I think it's easier to hold ETFs, but stocks, there's just too much noise out there. So what are some protocols to prevent retail investors from selling too early?
So every recommendation we make at 7investing, I have 3 things that we watch. The last part of every report that we write, which is a recommendation report, is what are the 3 things that investors should be watching? And they're not earnings per share and they're not revenue growth per year. It's things that are more inherent to the business that will tell you, if you look at those and you follow along every quarter, you can see, okay, this is going good. They're doing what they said they're supposed to be doing. Or maybe this isn't going well and it's time to, to get out. I think that as investors, it's fair to get out when things aren't going well rather than just committing, I'm going to stick around, I'm going to buy and hold and pray that things are going to get better. I mean, you can see the warning signs if you're looking at the right things. The companies have to disclose those. So I think that maybe the way to get away from that short-term thinking is when you're buying a stock, write it down or put it into an Excel or something that you can look at and say, okay, how did this go this quarter? How did this go this next quarter? How did it go this year? If those are trending in the right direction, then probably the company's doing all right. And you don't need to try to get in and out and be smarter than everyone else in the market every 6 months.
I wanted to zoom out a bit, but ties in with your investment philosophy and your experience studying innovative companies. And it relates to our last episode in terms of looking at different industries that can be disrupted. and could serve as a potential opportunity. So if I flip that question around, what are some industries today that cannot be disrupted?
Kelvin, would you like to answer first? I've got an answer, but I'd kind of be curious what you had to say.
For me, it's definitely semiconductors.
Yeah, good answer. For sure. I agree. The two that I came up with, the first one was pizza. Very hard to disrupt the pizza industry. It hadn't really changed for decades now. We all like dough and cheese and sauce, and we like to have it either delivered to our door. We drive a couple of minutes to go pick it up, which is why Domino's is still a fantastic investment. And the other is farm equipment. If you live out in a little bit away from the city in kind of a rural area and you're picking up things for farm, or you live out there a little bit. I have family that lives out there, south of Austin. They always go to the same place. Amazon's not going to ship that to you. Deer corn is too heavy to justify the air shipping to get it out there. I mean, stuff like that is just going to be, you go to the places you know and you trust. Barbershops, lawn maintenance, things that are very, very service oriented, hard to disrupt, stuff like that. And that's what you see too, right? You don't see MIT engineers going on disrupting barbershops or pizza. There are certain paces of innovation that's happening faster in certain pockets of the market and slower in other markets.
Pizza is a very interesting one. While doing my research, I do know that 7investing portfolio recommendations included Domino's Pizza. And I'm not going to disclose too much, but I would say the majority of those recommendations are innovative companies. And then you have Domino's Pizza out of the blue. So tell me more about this recommendation.
The team defense on this one, right? This is a company that consistently pours out profits, reinvests in buying back its own shares, or pays out dividends for investors. But think about pizza. Where's your advantage if you're a pizza company, right? If you and I are going to go start a pizza company right now, Kelvin, we might make a little bit of money. We might have some fun doing it, but we're probably not going to make a lot of money because nobody knows who we are. And so the advantage of a pizza company is you have a great brand that can consistently make the same quality of pizza and people keep buying from time and time and time again. And that's what Domino's has done, right? Domino's has been around since a single location in Michigan to now being all over the entire world, the largest delivery pizza company in the entire world. It is generating some of the highest return on invested capital in the entire market. And if that's an unfamiliar metric for anyone listening to this, that is the pre-tax operating profit your business is turning out divided by the invested capital in the business. So how much money are you making off of how much capital do you have available to create those profits? And so Domino's doesn't go out and build all the locations. They hire other people who are franchisees to do it, and they put their own money on the line to buy the location, to buy the equipment, to buy the ingredients from them. And then they just take a royalty off the top for doing all the brand building and the commercials and the advertising and everything else, the Super Bowl commercials. And so what you get is a return on invested capital that's higher than Tesla, that's higher than Alphabet, that's higher than Microsoft. It's Domino's Pizza. And as an investor, what more can you ask for? Consistent year after year, a company that's not going to get disrupted, that just steadily grows and understands the importance of profitability. Even now, in a time where ingredient costs have gone up and labor costs have gone up and fuel costs have gone up because of inflation, Domino's is still a fantastic investment.
People should maybe subscribe to your newsletter to learn more about the investment thesis behind Domino's Pizza. I think it's a very interesting one. While I was, scouting through the recommendations, Domino's Pizza came, and it was definitely a question that I was going to ask in this podcast. So thanks for sharing your answer on that. Artificial intelligence has been a very big buzzword, and it could be yellow flag for investors to invest in this space. Do you think artificial intelligence is a hype cycle? What are your thoughts?
It's something that the big companies have been working on for actually a very long time. You go back to some of the research that was being done at University of Toronto, even decades ago for ImageNet, the recognition of this is a cat picture. And then, how do you figure out through analysis of the pixels and the gradients of the colors, what images are and how you can just statistically train computers to figure that out. That's what AI is. It's been around for a very, very long time, 3 decades. But the reason this is getting so much attention right now, unsurprisingly to anyone, and knows what I'm going to say here, is GPT. The cat is out of the bag, and OpenAI has said, you know what, we're going to open this up to the mass market and we're going to start playing with it. And they launched GPT for free, and now everybody can use text and ask any question and immediately have the responses. Microsoft invested a ton of money to support them to do this. And so, of course, if you're Google, if you're Alphabet, and you've been working on this for a long time too, you don't want to get caught behind. They were trying to refine the biases of their own algorithms and their own AI models. But now once GPT is out there, cat's out of the bag, Pandora's box has been opened. Now all of a sudden BART is out there. Llama from Facebook has been released as well. Everyone else has got their own version of an AI large language model now. So no, it's not a hype cycle at all. Hype cycle would be something that just kind of comes out of nowhere and then everybody wants to jump into. Like if you remember the kind of the earliest days of 3D printing, even though that's been around for a long time, everyone thought that was just going to disrupt the entire world. Other examples, they're out there. Remember Long Island iced tea changes its name to Long Island blockchain just to jump on the bandwagon of cryptocurrencies. But AI is undoubtedly not a fad that's disappearing. This is a fundamental technology that's going to touch every single industry. It already is. And you already see, if you look at any job description page for any big company, they're hiring prompt engineers and people that know AI models very well. That's not a surprise. This is going to be ingrained in everything. But the thing is, I think that maybe we're making too big of a deal out of AI. Maybe we're just thinking that the expectations in this are higher than it needs to be. It's kind of like, do you even think about using the internet anymore? Or using spell check anymore, or having email filters anymore? I mean, all that stuff is kind of ingrained into products that we use every day. Microsoft is ingraining AI into its own enterprise products. Google is doing the same thing. It's integrating more and more AI, and it's getting smarter. You see now, you've got generative AI for Google searches. You don't think anything of it. And so hype cycle tends to apply to the earliest adopters, where there's an assumption that it's not going to cross the chasm and make it into the mass market, where it's just going to be a handful of people that are really excited about things and everybody else gets really excited and then it falls flat on its face off the plateau. AI is not one of those. AI is one that's going to be adopted by the mass market. It already is. And we're going to start seeing it get ingrained into everyday products.
Thanks for sharing your 2 cents on your views with regards to artificial intelligence. In our last episode, which is a follow-up, which was healthcare industry, I questioned what is the next big thing? And I remember you said it was a yellow flag term, but there are indications in terms of what's coming for humankind. And I think healthcare stocks is definitely one big opportunity that you mentioned. But in terms of performance, healthcare has actually lost a lot of its value. If you look at the S&P 500 using the benchmark index referring to the ticker XLV Healthcare Select Sector SPDR, it's lost a lot of its value. Do you still stand by this yellow flag, quote unquote, prediction?
Oh yeah, I definitely do. No surprise that the largest healthcare companies that are making up the largest constituents of those ETFs are dragging it down versus the S&P. I mean, think about the challenges that big healthcare companies face, right? Regulations, pushback on drug pricing, patent cliffs from big drugs that have been cash cows for years coming into generics. I mean, it's very difficult if you're a massive drug developer or pharmaceutical company or hospital. I mean, my goodness, my hat off to everybody who runs those organizations because there's huge challenges in them. But again, healthcare is so necessary to this country. It's a $4 trillion American industry. It doesn't matter if the economy is good or bad. If you're sick, you're going to the hospital. Drug developers are still going to push out new drugs, whether the economy is good or bad. Progress is still going to be there. And we still want to make people healthier and have more efficient treatments and better drugs out there. And so I love it as a long-term investing theme. I will disclose, without stating the names of them, that the last 2 recommendations I made at 7investing have been micro-cap drug development companies. Less than $1 billion in market cap. Super high risky. I've said extreme high risk for both of them. But I really like the progress they're making in some really important diseases. And they're independent. They're not the big companies. They're not these, $100 billion mega cap companies that have all these challenges. They're the small ones that are doing something innovative. And they've got a lot of risks. It's really hard to even get through clinical trials in the first place, much less go up against much larger competitors who've got a huge sales force and a huge R&D budget. But they're out there, Kelvin. There's some neat stuff going on. At the end of the day, it's the job of the FDA to assess the trial data, the actual trial data from these studies, and say, compared to placebo, compared to normal response, how are they actually doing in patients in these studies? And if you get something commercialized and you're a very small company that gets a big hit, you're probably going to partner with one of those larger companies that's already got the sales force to sell it, because they want a cut of that too. And science charges onward, healthcare innovation charges onward. I'm still as excited as ever about healthcare in America. It's very necessary.
I think healthcare is a very interesting one. I did speak to Luke and Dana about this. There are a lot of challenges. For example, patents, clinical trials, just to name a few. And I think there's a general consensus that it's going to take a long time for healthcare companies to make money, to make it an attractive investment for the average investor. So, how do we go about doing more research, given that studying a healthcare company might be very difficult? There's a lot of technical terminologies that you need to study. How do you go about doing the research?
There's a pretty wide continuum of how you can invest in healthcare, right? Healthcare is kind of a term that gets a sector weighting for a lot of funds, or maybe a fund that just invests in quote unquote healthcare. But like, you think about like, what is a healthcare company, right? Think about the risk profile of a massive pharmaceutical company that has a global presence versus a micro cap drug developer that has, some scientists and they're pushing through trials. I mean, even that is complete opposites. Or a hospital. Investing in a hospital is very different than investing in a medical device company, or a company that's doing cloud computing software to help these companies and enable them to get drugs through more quickly. I mean, that's a technology company rather than one that's doing healthcare or insurance, healthcare insurance. I mean, like, there's a zillion ways you can invest in healthcare. I think maybe the most important part for investors is, first of all, figure out how much risk you want to take. If you are going after a micro cap drug developer, you have to be comfortable with the risk that it could probably go to zero. If you fail a binary outcome like a clinical trial and you have no other assets, your stock is worth very little after it fails. And so don't go out there and bet the farm on something like that. But on the other hand, if you want something that's very stable, you can go to sleep at night and not be stressed out about it, maybe as a larger percentage of your portfolio because you're comfortable with the risk. United Healthcare. That's a healthcare company, the largest health insurer in America that just gets all these policy premiums, pays a stable dividend for investors, is the largest insurer of Americans for healthcare insurance. I mean, there's a bunch of different ways to play this. I think that as advisors, you need to know what you're getting into, what do you look for, and then what kind of is the thesis you want to build around that. For a company, like a United Healthcare, you'd be like, all right, what are the premiums? What kind of rate increases can they get from those? How fast are they growing? Things like this. Is there any kind of legal landmines that they have to address? That's a different thing that you'd have to assess than somebody who's very small, who's showing response rates of patients versus placebo in a phase 2 or phase 3 trial. Lots of ways to play the healthcare field.
Thanks for sharing your insight. And I want to shift gears a little bit, something that's probably more exciting and insightful. I recently went to MIT's 2023 ClimateTech Conference last week. What were some of your takeaways?
It's such a cool time up there. MIT up in Boston is a very academic place, and you've got docs and postdocs and PhDs and everybody else taking the stage talking about what it is that they've done all this research into and that they're really excited about. My perspective every time I attend these is, okay, what do we need to be aware of as investors that is going on in the bigger picture? In this case, climate tech touches the energy industry very closely. I think one of my biggest takeaways is that there's a lot of processes in energy and even industrial that has been burning fossil fuels, burning natural gas for heat, for process heat for processes, or for output products, that probably is kind of in the crosshairs now of a lot of this industry because they want to do the same outputs, but now you run these processes where they're actually just consuming lots of renewable energy, electricity, rather than burning natural gas as a feedstock. And so I think that's one of the biggest ones you're going to see. You see like Dow Chemicals of the world, the Microsofts of the world. They're committing lots of money to big projects that would be using energy to create the things that they need. Another big one is batteries. Battery storage is kind of already disrupted. The automobile market, electric vehicles are getting power from batteries rather than burning gasoline. And now we're starting to see batteries going into other places of the market as well. The grid is a big one that we're talking about. Battery storage for homes is another big one that we're talking about. We already know it's in cell phones and consumer electronics. But even though Elon and Tesla have gone all in on lithium ion gigafactories, there are other battery chemistries that could be very applicable and even more efficient for certain processes, right? For grid storage, where you need to store a charge for multiple days, maybe up to a week and a half, there are certain chemistries that are the right fit for that. If you're doing it for electric vehicles, you want really, really fast charging because you don't want to sit for 30 minutes where your car is charging. If you can do that in 10 minutes, there's a different chemistry that can work for that. Or versus, the safety considerations, economical considerations. Batteries is going to be a really, really big breakthrough in the next couple of years and different approaches to them. And then I think that the other key takeaway I have, and I posted this on 7investing.com, my biggest takeaways, but my third big takeaway is that the learning curve is going to be important for these. The learning curve means that companies don't start out with optimized solutions. There's no silver bullet. There's no magic bullet that all of a sudden solves renewable energy or batteries. It's just something that you iteratively have to improve over and over. And so your first plant, you build it, and then you build a second one that's 30% more efficient. You build a third one that's more efficient. Keep an eye on the technologies that are incrementally improving and are winning bigger and bigger contracts because the science is going to win out. And so this learning curve, your operating cost burden versus unit of output, keep an eye on that because there's going to be companies in the energy space that are going to be $100 billion in market cap. No doubt about it. It's just too big of an industry. We're going to see some winners emerging out of this.
I have some follow-up questions from those takeaways. The first one is, how can an investor evaluate the scalability and commercial viability of new technologies in the climate space? What are some metrics that you're currently monitoring per se?
One of the biggest ones right now that's being discussed a lot is policy, because there's such a tension. There's such a trade tension in the world right now, right? We've got a war going on, and now we've got another war going. It's like if you're going to scale something up, you either need to have domestic supply or really, really good trade relations with wherever you're getting it from. And this has been one of the biggest critiques. The critics of Tesla's approach is that their lithium ion batteries require a lot of nickel and a lot of cobalt, and that cannot really be sourced domestically. This is why gigafactories are going up all over the world, and Elon wants to have resource supply of these materials. And I mean, there's different ways you can do this, right? You can mine these ocean nodules that also have nickel in them. That's going to take several years to scale something up like that. Even the gigafactories themselves, and even lithium, by the way, is not just universal. I mean, this is why you're starting to see other battery chemistries being discussed, like zinc-based, like iron-based batteries, things that are just completely plentiful. But I think that maybe the first thing that investors should be aware of is that it's not just assumed. It's not just a foregone conclusion that even if you have the coolest battery design or even anything design, it's not just a foregone conclusion that you're going to be able to scale it up to commercial scale. Some people listening to this in your audience might be familiar with a company called QuantumScape, which got early backing from John Doerr, had the former chief technology officer of Tesla, JB Straubel was on the board of directors. It had the CEO of Infinera, who is now Jagdeep Singh is CEO of the company. I mean, really some high profile fellows backing this, but it was proprietary design of the battery separator and the electrolyte. It was something that was not just materials that you go out there and source really, really easily. And so we've kind of seen, even though QuantumScape has said, lithium metal is the way to go, look at the energy density, look at how fast we can charge, look at how far vehicles that are using this can go before you have to recharge again. Just the nature of a proprietary design for batteries has been a little bit harder than I think that many were expecting. Maybe that's the first and most important takeaway is these things are very, very difficult. And automakers are aware of that too. If you're going to sign on to a battery supplier or you're a utility that's going to sign on for a renewable energy power provider, you better be able to get the supplies you need to run your own operations and have plenty of volume with them. Otherwise, you're not going to do a deal with the big guys.
Were there any indications from the conference regarding the timeline for widespread adoption of battery storage by the masses?
I mean, it's kind of already happening, right? I wrote down an interesting statistic for this. Wall Street Journal reported it, that battery electric vehicles, not hybrid, but only battery electric vehicles, was 3% of the global light vehicle market in 2020, a couple of years ago. It's about 70 million globally light vehicles sold. 3% of those were battery. Would you like to guess what percentage of the global light vehicle market they were just 2 years later in 2022?
I have no clue.
It was 10%. That was about 80 million units sold, right? So an increase of 10 million units and an increase from 3% share to 10% share. To me, 10% of a market that's selling 80 million units a year is already, this is happening, right? This is already out there. And it's $1 trillion market when you think about how all the passenger vehicles being sold. It's $1 trillion. And you're starting to see, Tesla's got a really big part of that. There's some Chinese companies, BYD has got a really big part of that. NIO is a Chinese company that's got a very big part of that. The volumes are scaling up. No one's getting left behind. It's a question now of, are you going to try to do this internally on your own terms like Elon likes to do with Tesla? Or are you going to start trying to build partnerships to build out this new supply chain, which looks a lot different than the supply chains we built for the automotive market in years past? But I think that maybe to answer your question, we're going to see it. It's here. It's happening. And, the next rollout of the next new generation of electric vehicles will be 3 or 4 years out from here, as kind of we see more and more efficiency of battery technologies.
How do you see the dependency on fossil fuels and oil in the next couple of years?
It's still very much there. Even though every time a new electric vehicle displaces a internal combustion vehicle, that's still less of a need for fossil fuels for that vehicle. But this is not going away anytime soon. You just saw Exxon, make a huge acquisition, going all in on shale. Natural gas is still going to be very necessary. Jet fuel, there's still no way that you can have an electric powered plane that crosses the Pacific Ocean. Still so much of consumer packaging and the plastics industry is built upon hydrocarbons. And I don't see it going away anytime soon. It's just that there is progress being made, even in a conference like ClimateTech, that you can kind of start seeing, the direction's going this way. But the magnitude of numbers is still built upon the things that we've done for decades. So I still think there's a huge reliance on fossil fuels. I worked personally in a very large integrated oil company that was doing renewable energy projects, and we still didn't want to disrupt the rest of the business. There was hundreds of thousands of people that worked there, and cash flows that came from the core of what they were doing. Those businesses are aware that these are going on out there. They want to participate in them, but don't completely flip the script of what you're doing overnight.
I did have a follow-up question with regards to your last takeaway, which is the learning curve of new technologies. You did mention that policy plays a role in terms of speeding the learning curve, also subsidies, large customer contracts. I'm also reading from your webpage the takeaways. I'm curious to know, how do we avoid falling into the pitfalls of investing in another 3D printing revolution that wasn't?
Yeah, well, first and foremost, 3D printing was assumed to be a consumer market. Do you remember it, Kelvin, when everyone was talking about having your 3D printer right next to your sofa at home? And you were going to print up toys for Christmas and just, put them in a box and then give them to grandma. That's just hard because the costs associated with any consumer market have got to be so low. Otherwise, you can't afford it. Some people were tinkering around and making fun things, but it was still 3D printing had its place in prototyping for the auto industry, and that was the majority of profits. This is a very different market when you're talking about renewable energy because it's such a long time frame and it's so massive, trillions of dollars, that you have to have some government funding that's backing this. And businesses are going to figure out how this applies for them, right? Dow Chemical is going to figure out how can you use process heat from something like the steel industry. Gives off a lot of carbon dioxide emissions. So is there a way that we can use renewable energy plus hydrogens to superheat to create green steel? Fertilizer industry, that's another industrial application. Can you use electric processes instead of the traditional way using methanol? Industrial is going to figure it out, but in terms of electricity, that has to be the government that's doing that first stake in the ground for this learning curve to make it more efficient. And like you've seen, what was it, 2021, $1.2 trillion bipartisan infrastructure bill that was out there. 2022, we had the Inflation Reduction Act, $370 billion committed to clean energy for that. This year, or last year rather, 2022, Department of Energy has got $400 billion in loan authority to lend to clean energy companies that are scaling up. It's that first massive amount of money that you didn't have for 3D printing or anything else out there, blockchains that kind of rode up and down the hype cycle so quickly. this is something the government is committing to be in for the long term. And they're going to give a lot of money to get the first wave of this figured out. And I mean, it's interesting because it's going into capital. It's not going into marketing. It's not just going into labor. It's going into building plants. One of the presenters was building $1 billion solar PV plant in America that's going to employ 1,000 people. Right? One of the other presenters was doing an iron-based battery that was going to build a facility in West Virginia, employ at least 750 people. I mean, these aren't just projects, that it's like, oh yeah, we'll get around to it. It's going to work when it does. It's like, this is a massive amount of money going into the capital required to make these more and more efficient over time. And so I think to me, this is not just hype. This is not just a fad. This is billions, if not hundreds of billions, if not trillions of dollars of honestly taxpayer capital. These are coming from funds that the government has sponsored, at least America government has sponsored, because they want to abide by the 2% Celsius, Paris Accord, the commitment that's kind of agreed upon. Joe Biden and his administration has put a lot of money behind this. And it's not like you're going to spend that kind of money and it's going to disappear overnight. These are long-term projects that are going to take 10 years or more. And we're putting the first steel into the ground to make them happen.
It's a very interesting topic that you opened up with regards to funding, not just government funding, but it could be any type of funding. I feel like there's a lagging effect once the funds go into a company, and it takes time to really build out a product that's durable and scalable. And I think a lot of retail investors fall into the trap of they see a prototype and it seems really promising and they invest a bunch of capital into it. And then it becomes, quote unquote, the hype thing that's happening. So would you say funding takes time for a product to come into fruition? And how long does it usually take as an investor to continue to monitor?
It's interesting because when I asked you kind of off the cuff what industry would be hard to disrupt, you said the semiconductor industry, which is a great answer because there's so much capital involved in that. I would agree that there's a reason that Taiwan Semi remains the largest foundry in the world, because it costs $40 billion to build a new fab anywhere. Most people don't have that kind of money or that kind of expertise to even do that, which is why you've always got Taiwan Semi, Samsung, and now Intel as the top three in terms of fabs. There's smaller ones, but that's the top three. Some markets like software is very opposite. You're paying smart people to do coding, but there's no stable competitive advantages from this. But capital can be a competitive advantage for things like this, where it's very hard to get the efficiency of solar cells higher than what you can do right now, or it's very expensive to build a gigafactory that's going to compete with Elon. Even the new battery suppliers, for automakers, if you've got a ton of money, you can do it yourself. That's great. If you can't, you want to team up with somebody who's got the long-term feasibility to build something. It costs between $20 and $100 million to get a pilot scale line up and running, to even get kind of pilot scale development projects going for batteries. It will cost you $500 million before you can be producing them at commercial scale. Who's got that kind of money? The large automakers? Sure. Everybody else? No. Probably not. That's why QuantumScape is, teaming up with Rivian. That's why you see others that are dealing with other battery suppliers for EVs. And I think it's the same thing with renewable energy. If you're a large utility, and for you at the end of the day, you just want to provide your consumers electricity so that they don't have brownouts. You've always got enough energy on the grid for demand out there. If you're working with energy providers, you want to make sure that, it's clean energy because the government loves that. And there's not as many regulations on it as there is for something like a coal plant. But, you might not want to do that all on your own. You might want to team up with others that are doing it. But again, I think the capital is certainly a huge competitive advantage in this space. When you think about the timeframes, several years, how long does it take to get a mine up and running if you're using certain components from renewable energy? 5 years at least. If you're going to build a plant, what's it going to look like? At least 5 years. One of the hot topics right now we haven't even discussed yet has been small modular reactors, nuclear reactors, that are not these massive $50 billion projects, that are much smaller in size, but are still able to provide power during the times where the sun's not shining and the wind's not blowing. And those projects are getting signed into power supply agreements that won't even go into effect until 2028, 2029. That's 6 or 7 years from today. These things take time and they take patience. But you start to see as they get better, iteratively stronger, this learning curve is coming into play, and they get harder and harder to disrupt. And all of a sudden, we're at a point like Taiwan Semi is in semiconductors, where you cannot disrupt them because it's too expensive and too hard.
Thanks for sharing so much wisdom and what you're seeing attending all these exciting conferences and networking with so many investors out there. I think it must be a very memorable experience. So this pretty much almost wraps up the episode. But at the end of every episode, you know the drill, is I tend to ask my guest speakers to talk about an investing mistake. In our previous episode, you mentioned a few mistakes. So I'll let my listeners listen to that episode first. But I wanted to zoom out to understand or talk about experience with regards to a specific investment recommendation that you made that resulted in significant losses for your audience. How did 7investing handle the process and the aftermath? And what changes did you have to make to your investment approach as a result?
Kelvin, I might have to go back and listen to episode 23 again. I don't remember what I said last time, but maybe I can refresh my memory on what it was then. But investing is, if anybody's claiming that they're going to be right 100% of the time, they are lying. Run the other way quickly. Everybody makes mistakes. And if you're very, very good in this business, you're probably going to be right 6 out of 10 times versus the S&P. You will underperform the market for 40% of the time. With the type of investing that I like to do, that offense, team offense is going after growth style investments where there's more risks, but greater rewards. It's more like 45%, actually, less than half. Now, why does that make sense that less than half of your investments are actually outperforming an index fund? Well, the answer is because there's no ceiling on the upside. And if you catch something like an Amazon or a Netflix or whatever the next most innovative company is going to be, you can very quickly get a 5-bagger, a 10-bagger, whatever else it is. And even a small initial allocation, if you let it run and it keeps doing well, will completely change your entire portfolio. It did for me, Kelvin. I self-funded 7investing from gains off of Tesla from a long, long window of time, which was fantastic, right? Just kept adding to it over time. And then what was it, 2020? I don't remember what year it was. There was one year that Tesla was up 730% because they started scaling up. And really, if you remember, a lot of people thought Tesla was going bankrupt. They didn't think they had the capital. They didn't think that Elon was going to put his money where his mouth was. And then he did. And if you think about that same kind of methodology, approach to investing, there's a lot of companies out right there right now that I think are doing really innovative things that people are not giving the benefit of the doubt to. I say always invest in innovation and don't be afraid to be wrong. Because yeah, you're not going to bet 100%. But then if you catch a couple of the next Teslas, the next wave of Teslas that are out there, you're going to be glad that you did. And it's going to be okay that everything didn't work out. That didn't answer your question though. You asked me a question of which one was my mistake. And perhaps the mistake that I'll share has been Jumia. Jumia was trying to do e-commerce in Africa, similar to how Amazon is the #1 regional provider in the United States, similar to how Alibaba and JD.com have become the unquestioned leaders in China, and similar to how Mercado Libre has become the undisputed champion in South America. They said there was an opportunity for winner take most in Africa. And so they had 2 former McKinsey consultants that were going to go out and build the supply chain and use technology to crack logistics and warehousing, and then also crack the payments, similar like PayPal was used for eBay. And they went after Africa, and it was a very good methodical approach. We had very smart consultants that were looking at, logistical costs and said, we're going to control our marketing costs and we're going to just look at this diligently to make this a very, very profitable business. And it was just not that easy. Even with a long-term mindset, even with this smart approach they were taking, Africa is a pretty big place and its infrastructure is pretty undeveloped. And most people are still using cash. And they don't even have, in a lot of places, credit cards or smartphones that you can accept payments for. And it just did not scale, even with this great plan in place, the way that Jumia thought that it was going to scale. And so they've left. The co-CEOs are now out. They've got a new CEO that's come in and has basically said, we're going to take this giant footprint that we thought we were going to have. We're going to exit most of those markets. We're going to focus in on the products and the regions that are profitable, because we're literally just lighting money on fire for some of this stuff that we thought was going to scale more quickly than it was. And Jumia was a huge loser over long periods of time. A lot of investors made some money on this company if they got in early enough. A lot of investors lost money on this and they got in after the hype was built in. But again, was it a bad investment to make at the time? Maybe not. Maybe it was just one that the innovation curve didn't play out quickly enough and the scalability of what they were trying to do didn't happen quickly enough for this to work out for investors. And so when you look at something like that, it's not one that we were just throwing caution to the wind and putting money into. It's just one of those that, innovation is hard, scalability is hard. Africa is a much, much larger place than maybe Kupang or somebody that's going after South Korea, where it's much more urban and densely populated, could do. But should that discourage you from investing in innovation? I don't think so. I think that, you just have to kind of have the mindset and the expectation in the back of your head that maybe 6 out of 10 is not going to beat the S&P, but some of those will. And as you look at battery suppliers or climate technology or clean energy or any other market that's got innovation happening at a quick pace, AI, biotechnology, payments, whatever it is, this is why we like to always close out every report with what's important to watch. Don't just look at earnings per share or short-term revenue growth. There's a lot more going on behind the scenes. Keeps us busy. There's a lot to tackle out there, but it's also a pretty exciting time to invest in innovation.
Simon, thank you so much for your time. That wraps up our episode, and it's such a pleasure to have you, as always, to share your wisdom. I got to understand how you run 7investing, and I'm sure my audience have learned a lot from this episode. I just want to say thank you for your time, and I can't wait to have you again for a third round sometime soon.
Kelvin, it was a real pleasure to be here. I just promoted your show to my audience as well on X. I guess it's X now. But you prepare fantastic questions and you really do get to the second and third and fourth layer of everything that you look into. It was a real pleasure to be here. Thank you very much for having me.